Hey everyone, it's Imran from Options Insight with your macro options spotlight. Okay, S&P rallying again, continuing to move higher, as were European stocks yesterday. So they were up about 1.5%, which is nice. China, on the other hand, was down 10%. Absolute brutality in China. And that is a vol-adjusted move on the week of 2 sigma on a vol that's in the 40s. So it just tells you how massive that move actually was. And it was basically the market reacting to a new committee put in by Xi after he had obviously reconfirmed his power, that was not deemed to be market friendly. And it seems that COVID zero policy is going nowhere. It seems like common prosperity is the goal, and that's going to be at the expense of growth and the stock market and shareholders, basically. So foreign investors getting the hell out of China, and you're seeing the Hong Kong listed indices all down order of magnitude of around 10%. Obviously, vol exploding on the back of that, up 5 vols on the day. I wouldn't get in front of this. This is one of those things where you have no idea where the bottom is. It's at the mercy of what these guys want to do with it, and we don't really have any edge playing that. So I would stay the hell away out of there. And for those of us who've been throwing a little bit of premium upside calls, I don't think I'll be doing that again in a hurry, basically, whereas the space has become pretty much uninvestable. Now, if you've got a 5-year view that China is going to come out of this at some point, maybe you start averaging into long-term exposures. But from a tactical standpoint, I wouldn't touch it with a barge pole. Anyway, that's enough ranting on China. If we then look at what else is happening, commodities and FX have been fairly quiet in terms of spot moves. Copper was pulling back a little bit, obviously on the back of a China move. It's got some correlation there. FX was relatively quiet, except for dollar yen, which was up about 1%, back at 149. And that is despite what looks like intervention. So I don't think they've admitted the intervention, but certainly the moves look like there's been some intervention attempts in the yen, and yet it just keeps ripping straight back in their face. So it seems like these interventions are becoming more frequent, but less effective, as I tweeted the other day. Let's see how that plays out, but that's not a good sign for the Bank of Japan. And then finally, yields continuing their move higher. You see TLT again down on the day, another 80 basis points, now at 92.5. This thing has been in absolute free fall. When is the bottom in on this stuff? I have no idea. But at least the velocity of the sell-off is calming down, which is why we are seeing implied vols softer on the day, down 1 vol despite spot lower. And I had flagged that TLT vol was unsustainable at those levels, and it's starting to confirm that in that it's coming down, even though spot continues to go lower. All right, in terms of vols, we already kind of said China up, bonds down. We're seeing a little bit of a bid coming back to commodity vol, but nothing to write home about. And then FX-wise, drifting a little bit as well in the cable vol and in dollar yen vol even, whereas China vol, obviously, CNH vol up in line with what's going on in China in general. In terms of carry, we are seeing the best carry in European stocks and in TLT. We'll talk a bit about that later. And in terms of skew, absolutely battered still. S&P skew just cannot find a bid. Down another half a vol point to 3.5, and that literally has got me on the 0.00 percentile on an 18-month look back. Investors seem to fear the melt up into year end a lot more than they fear the sell-off right now. Call it complacency, call it everyone underweight and short and needing to protect the rally. Who knows what the reason is, but that is what the vol market looks like. So for choice, I would say it's probably not complacency. It's probably the latter, where no one really owns enough of the market. And so they kind of need some calls on the book just in case we get this positioning driven rally. People talking about CTAs having to buy hundreds of billions if the market goes about another few percent higher. So people kind of really scared about that and kind of using call options to make sure they have some exposure in case that were to occur. And then China skew, obviously, ratcheting up 3.5 vols there to 7 vols. You never see China skew at those sort of levels, really. You can see 87, 88 percentile. It's pretty rare. Wouldn't be surprised if that was short-lived, but I'm not going to step in and play China right now. I think it's too toxic. And then finally, TLT skew pulling back half a vol in line with what the implieds are doing, but still very elevated at 96 percentile. All right, that's the summary for today. If we now move to what else we are seeing. Rishi won the race to lead the Tory party. So he has now officially become the next Prime Minister of the UK, as the last candidate withdrew from the race. Gilt seemed to love it. So you can see that we had a big drop in 2-year yields in the UK, went from 380 to 340. That's kind of the biggest daily drop in like 30 years. So it's basically an endorsement from the bond market that adults are back in control and they're not going to do anything stupid. So the next focus is going to be on the fiscal package details that are going to come out by Halloween next week. Obviously, after all the recent turmoil in markets, I suspect they're going to do their best not to be too controversial on that and shock markets too badly. So I'm not expecting anything groundbreaking out of that that's going to really rock the market. Maybe now the focus can shift towards Europe and Japan. They've both got central bank meetings this week. PMIs in Europe were not great, but the market's seeming to look past that for now with stocks and the FX rallying. So that's encouraging. I had said that, I felt PMIs might have a chance of having an uptick on the back of the energy. I think that's probably a bit more lagging. So we're going to see that maybe next month or two. If energy prices stay lower, the PMIs are going to start to bounce. But for now, those numbers came out pretty bad still. I've also thrown in the chart here on UK equities trading at a 40% discount to global peers. This is what Bloomberg is saying. Obviously, they've been kind of shunned on the back of all the nonsense that's happened recently. But given that we may have some adults back in control, given that we're getting some calm back in the yield markets, that might mean UK equities start to perform a bit better and they might start to find a bid. So we'll see what happens there. I don't think people are going to rush back into UK equities, but maybe they're not going to absolutely collapse now that we have the outcome that we have in terms of who the Prime Minister is. All right, if we then move on to sort of what trades we're seeing. FTSE realized vol absolutely collapsing. So we're saying UK assets, maybe are going to do okay, might be in for a better period. You would have thought that the FTSE was moving around given what's been going on in FX and bond markets in the UK, but instead, FTSE realized vol is absolutely collapsing, right? So you can see here, it's absolutely tanked from the 30s down to like sub 10, right, from a close-to-close perspective. So if you look at the vol carry, that's in the 99th percentile at 12 vols in terms of the FTSE. Our strategy compass is telling to sell calls. I'm not so sure about just selling calls outright, but I think selling vol certainly is starting to look attractive in the FTSE, given what's going on and given that we've got a bit more clarity now who's running the show. So Eurostoxx carry also looks favorable. We saw that in our vol summary page. I would prefer to steer clear of the ECB meeting this week, which will probably move European markets, and a focus on the FTSE. So if you're looking to harvest carry anywhere, I think selling FTSE kind of makes sense, especially now that we know we've got a prime minister who's kind of got some clue about financial markets. So that we may well get implied volatility in the FTSE start to track closer to that realized. That realized might not stay at like 7, but it might bounce a bit. But the implieds are still relatively elevated at around 20, so they've got room to come down. The other thing I want to flag is, obviously, we mentioned China absolutely puking. TLT kind of doing the same thing, right? Big difference between this. So the charts look very similar. They're both tanking through the bottom end of the Bollingers. Look, it's hard to know where the supports are. And obviously our strategy compass when this happens tends to have sell puts. Like we're literally off the charts nearly in these, right? Selling put territory where the spot is so low and the vol is elevated. So that is the obvious mean reversion trade. The big difference between FXI and TLT is the carry, right? So you've got charts that look very similar, but the realized volatility on TLT just cannot keep pace with the implieds, which is not the case in China, which obviously just had a 10% move. So we think the opportunity, if you're looking for carry, is still in TLT. We think that vol is elevated, obviously. We think it's got a fair amount of downside. There are ways to play it. We're looking at potential diagonal calendar structures, both on the upside and the downside, to play the term structure, to not be short too much outright vol, because who knows what the vol can do. We're in uncharted territory here in terms of yields. But we do think the most likely outcome is some sort of stability coming back to TLTs, and these vol levels are a bit inflated, and we want to try and earn some of this nice juicy carry that TLT is showing us. And that's the other trade idea in today's daily note. All right, that's it for me. Thanks for listening, everyone, and I'll catch you guys tomorrow.